Howdy, Jacob here. Today we're looking at CSG Systems in the IT services industry. Just under 1.4 billion market cap, just over 1.8 billion enterprise value, with growth in the 3 to 6% year over year revenue growth for the last 10 years. Just kidding. The SIU COVID declined 0.6%, as high as 13.9% revenue growth, but really just pretty close to inflation, maybe a little bit higher. Gross margin relatively flat at 48%. Operating margin, same story, relatively flat at 12%. They do pay a dividend. Their dividend is paying out over 50% of what we're seeing in the earnings per share. So it is a pretty hefty dividend. Return on invested capital, upper single digits. Return on asset, mid single digits. Income statement shows 143, most recent year, 146 million R&D spend. That is over 10% of their revenue. So they are taking money away for future growth, hopefully, and future efficiencies. 186 million cash on hand, 8 million short-term debt, 535 million long-term debt. Let's say about 500 million in relation to their free cash flow is a little bit less than 5 years. They've produced on average over $100 million. And so they will have to focus a little bit of money on debt reduction, but it won't have to be a significant portion, I would think, of the capital allocation. 34 million in dividend is about 30 to 35%. Share repurchases is a hefty amount. Otherwise, a little bit of acquisition and reinvestment. So I think I'm ready to start making some assumptions here. On the revenue growth side, I'll probably stick with about 4%. This is saying that they get the 2 to 3% from inflation, and then maybe acquisitions and reinvestments give them a slight bump. I do like that free cash was a bit higher. It'll do 7 to 9% there. Share change, 1% repurchase would be about 14 million, 28 million, 60 million. I think that's 60% of free cash flow is a bit significant. Maybe we'll do 1%, and you're looking at about 50 million, 50%. I think I'm comfortable with that. The dividend, paying out 30%. I'll probably just keep it where it's at so that when they do find reinvestment opportunities and acquisitions that make sense, they're able to do that. Margins of 4%, 7 to 9%, probably deserves market average PE. I don't think it deserves anything too extra. So again, this is assuming a little bit of capital allocation goes to debt reduction, a little bit goes to acquisition and reinvestment, about 40 to 50% to share repurchases, and then about 20 to 30% to the dividend. And we're saying it needs to fall 39% before you get the return I'm looking for here. So I will just be waiting patiently until it gets to a more attractive price and reviewing other companies in the meantime. Hope you enjoy the video and have a great rest of your day. Thank you.